Hi, this is Rick Savitsky from Chortek. I lead a team of accountants and data analysts, and we love helping manufacturers be more profitable, operate more efficiently by giving them excellent reporting tools and data analytics and helping them make great decisions. In this video today, I'm going to talk about a topic which is very important in understanding costs, estimating selling price for a product, and making sure that you've got a good feedback loop in understanding where indirect costs or burden or overhead are impacting both operationally and also on your financial statements. So in this video, I'm going to give you an overview. I'm going to show you how to calculate it, and I'm going to show you how you can use it in your operations. Caveat, this is not a simple topic, and so I'm going to give you an overview. I'm going to use a few terms interchangeably. Overhead and burden, basically the same thing. Part, work order, shop order, project. From our manufacturing perspective, those are all the same basic ideas for the purpose of this video. And the actual concepts of how you implement these in different manufacturing software packages are going to be different, but I'm covering it at the high level and the conceptual level, and it should be applicable to just about any manufacturing application. So why is this important? Well, your costs, specifically your indirect costs of manufacturing, are crucial to make sure they are accurately understood, captured, and part of your reporting cycle, your financial reporting, your operational reporting, but also, of course, that it's built into your cost of production properly, so you know what your true costs are, so you can properly price what you're selling to your customer. That's why it's so important. And if you aren't measuring it properly, you can't manage it. And I'm going to give you some examples of how you can manage it in this video. So let's begin. What is it? Here's a definition, my definition of applied burden and overhead. We are going to be capturing the costs, payroll benefit, tax, payroll taxes for indirect or supervisory employees, or both, and keeping them separate from direct shop floor employees, separate from salespeople, from office personnel. We're going to specifically look at indirect. We're also going to capture the cost of depreciation for equipment, machines that are used directly in manufacturing, the cost of supplies, repairing of machines, and various other items that are indirectly applied to production are going to be clearly identified and captured, as well as rent, utilities, and so on related to production. Not the entire facility or building, but related to production. So we're going to capture all those costs, and then we're also going to apply or absorb a cost rate to offset those costs so that those costs are going into the cost of manufacturing, cost of goods sold. So we're going to be in the general ledger capturing our actuals, and we're also going to be applying or absorbing those with every hour, essentially, of production that occurs in your business. So that's the definition. Now, how do we calculate it? I'm going to walk this through step by step. Using the sample chart of accounts, we're going to be capturing from the payroll system, again, our indirect cost of payroll, taxes, and so on. And potentially, we may have another segment or a class or a dimension that's going to do that by department or unit. But either way, we're going to be capturing these costs, and we're also going to be capturing other costs. So I've got a handful here listed, not all of them, from the prior slide. Really anything that's related indirectly to manufacturing. Now, caveat, we don't want to pile too much into this list. So office rent, office supplies, personnel salary for office, sales commissions, and so on, those do not go up into this area. And I've seen and heard and observed others that argue, well, everything should be in here, and you absorb all of your overhead and burden and create a burden rate that calculates, that captures all of it. I disagree, because your financials, if it's done properly, your financials then don't make any sense. So key point here is we want indirect costs, And another important piece here is depreciation can be kind of tricky. There's different ways of tackling that. So I'm going to cover that in another video. Main point here being what is being used for depreciation should be easily tracked and then totaled in your chart of accounts. And if it's not, work with your accounting team to recalibrate things, reorder, renumber, etc. Okay, moving forward. Offsetting these actual costs are going to be an entry that's going to be posted from your manufacturing system essentially every day as hours are logged, either personnel hours or machine hours or both. They may be one and the same depending on how you capture your time. But these are going to be negative amounts, credits that are going to be offsetting these. And I'll explain that, how we calculate that in just a second. So that's going to be offsetting it and ideally allowing you to net down to zero so that what's unapplied, ideally, for a given month, quarter, etc., is near zero. That's the whole idea here, the main point. In this example, I'm not making a distinction between fixed and variable overhead. Suffice to say, that's another way of getting more detailed of how we drive the cost and post it, but the end result here is still relatively straightforward. What are our planned or expected and then actual costs of indirect manufacturing? And then are we properly applying it to every part, work order, job, etc. as we do our day in, day out business? That's the objective and the goal. And you could also think of this value, if there is something left over, if it's a positive number, is basically the cost of inefficiency. So for a given month, if we have $100,000 worth of all these indirect costs, and we've applied $90,000 through the applied burden and overhead, that leaves $10,000 left over. $10,000 which didn't go up into the cost of production. So I'm going to call that cost of inefficiency. And it can be black and white, 10,000 that you'd see on your income statement, very simply. And it can also be helpfully measured and expressed as a percentage, in this case 10%. Okay, so how do we get this applied burden value posting, and what rate are we going to use? And so that's this applied burden rate concept. So it's not that complicated. We're going to take our planned estimated costs from the prior slide, and we're going to divide that by the planned estimated hours that are going to be logged through the system one way or the other. This might be a one-on-one relationship between direct labor hours and machine hours. Maybe they're going to be recorded separately, and it all depends on your manufacturing environment and how you're capturing your time. But the main idea is you're estimating how many hours are you going to be incurring, and we're comparing that, dividing it, and we're getting a rate. 50 per hour, 70 per hour, $22 per hour. The point is it's a rate per hour, and ideally that's going to be done by work center. So if we have 10 different work centers, we could have potentially 10 different rates based on those planned production hours. Not every work center probably has the same capacity, and that's why we can get different rates. So that's the calculation and the logic. Here's an example where we'd actually put that value in. So in Acumatica, we literally can populate an overhead rate, and notice here we can do it either by machine or labor hours, but essentially when we're all said and done for a given work center, we're defining a rate and literally keying in a value. In JobBoss 2, E2, same basic idea. For work center setup, there's a field, we just basically populate what is our burden rate. So different terms, same idea. This is literally the value and what we do with this calculation. As time passes, once a few months go by, a quarter, 6 months, you're going to want to make sure that you're periodically recalculating this value, these values, and then updating the production system in the right place so that it's reflecting what you think the values will be in the future. This is all about trying to estimate and get close to zero with your planned expenses, indirect manufacturing expenses, and how much is being absorbed. So if your capacity changes, this rate needs to change. If your planned expenses need to change, because you know you're going to need to having higher or lower repairs, for example, then this rate needs to change. And that's probably one of the biggest weaknesses that I see our companies go through this exercise and then they forget about it. And that's really a danger because you're not making the financials aren't making as much sense as they could, but even more importantly, it probably means you're not quoting new work at the right cost. And that's the key thing that you can manage. So how do you use this? Well, we're going to want to set a target and then start measuring it. And you're going to be investigating variances, particularly with this concept, because there can be two reasons why, if you look at a profit and loss statement, why there may be a positive or negative amount left over for any one period of time, month, 2 months, 3 months, and so on. And then you're going to work to improve it, improve the results so that you're getting closer and closer to zero and you're absorbing as much of your indirect expenses as you can and recalibrate as needed. So I'll give you two examples using hours in this case. So we commonly will deploy Power BI as a tool for management and production to keep track of things exactly like this. How many hours were we planning and how many did we actually incur for a week, month, etc. So in this case, we've got a variance between our target and what's actually been incurred. So if the variance is large enough, anyone can click and basically expand and see, well, what's the detail? By specific machines, I'm now able to see the 3 machines that make up this value. Here's my column for planned hours. Here's my column for actual hours. And then a calculated variance. So a red flag means, hey, you plan to run 118, but you've only run 89 for that time period. So that means you are under capacity. You're not producing as much as you thought you could, which also means if you came up with a calculated rate per hour of $50 of overhead, you're not applying that much into the product you're producing. So a variance here, if this was the only reason that there was a variance, could be explained by hours. But of course, it's normally not that simple. There's other reasons. So here's an example. We got an old piece of equipment and we were planning to spend $10,000 for a month on repairs. But what if we spend $15,000 because it took extra time, extra expense in order to repair it? Or conversely, what if we deferred it and we didn't spend the $10,000? For that month, we might have a $10,000 positive variance or a $5,000 negative variance depending on when we actually incur the cost that we were planning. So the difference here is what did we plan for our indirect manufacturing expenses and what did we actually incur? And if there are differences, that would explain why it doesn't always come perfectly to zero. Total plan costs, total applied overhead and burden. That difference, if it's not zero, can generally be explained by these two elements, dollar or an hour variance. And if you pay attention to the details, you can get closer and closer to understanding why your financials are sharing what they are and focus on improving profitability by making sure you're properly quoting. If you're a job shop, you're properly adding the right markup over your costs. And if you're discrete manufacturer, that you're periodically making sure that your selling price for your product is properly reflecting of your underlying costs. We'd love to help you if you have questions on this. This can be a little complicated, and if your current accountant isn't providing you great advice or assistance on this, we'd love to give you to engage with you and give you a hand. Do me a favor, if this is helpful, give it a thumbs up and share it with others on social media. Thanks a lot. Bye.